Hello everyone, I'm David Scranton, host of The Income Generation, and thank you for clicking on this video where we start to address this issue of inflation, right? Unless you've been living under a rock over the last 6 to 12 months, you've been hearing about inflation. Is it transitory? Is it permanent? Is it gonna run away? Is it gonna get back under control? Today, we're gonna address those issues, but I wanna start with making sure everybody understands basically what inflation is. Now, you may have taken some economics courses in college, and you might feel like, well, I know it, I don't need this basic definition. But let me give you a refresher, because the reality of it is that inflation doesn't have to be as complex as everyone likes to lead you to believe it really is, okay? Because it's not. What is inflation? It's essentially too much money chasing too few goods. You see, when in a free market, a capital market, when you have a demand for certain goods and services, and you have a certain amount of them available, a certain supply, and those aren't changing, you have what's called equilibrium. Prices stay pretty stable. But if the demand grows, where there's more people that want that good or service, but the supply of that good or service stays the same, then the price goes up. Or if the demand stays the same, but let's say the supply that's available goes down, now the price has to go up, right? Simple. What we've seen since this recovery, since we opened up the economy after COVID-19 hit us in March of 2020, was really both. We saw an increase on the demand side and a decrease on the supply side. And that, of course, is a terrible formula for inflation. So first, let me address the demand side of it, and then secondarily, we'll address the supply side. But before I even get into that, I want to answer the question, is it permanent or is it transient? Well, it's always transient. Inflation is never permanent. Permanent means forever, right? So in the literal sense, inflation is transient. Why? Because at some point in the future, it's going to go back down. At some point in the future, we're going to have a bad recession, where GDP, our gross domestic product, our economic output of our country, if you will, goes negative, where we're actually going to have a deflationary year. The prices are going to come down. That's going to happen. So it's not permanent. So what do economists say when they're debating about, is it permanent or is it transitory, which is a fancy word for temporary? Well, it depends how you define the word permanent, right? And some people might define permanent as, gee, we've got high inflation for 3 years or 5 years or more. But others might say by the end of 2022, if inflation doesn't go back down by the end of 2022, then it's permanent. Some might even say it's already here if it doesn't go back into check by the end of 2021. And what does inflation getting back into check really mean? Well, if you're my age, you know, you lived through the 70s and 80s and you saw double-digit inflation. You saw 10, 15%, prices going crazy, gas lines, fuel prices went through the roof, right? Those are double-digit inflation rates. All we're talking about now is maybe inflation at 5%, right? So you have to put it in perspective, because we've had inflation at 2% or even a little bit less now for many, many years. We've been spoiled and conditioned to think over the last 20 years or so that that's all inflation the inflation rate is going to be. Prices are going to go up by maybe 2% a year. But that wasn't always the case. You know, when I was a young financial advisor, late 80s, and maybe it was a little higher in the late 80s, but we got into the 90s, all of our inflationary assumptions we'd make in financial planning were 3 to 4%. That was average, right? So you can argue that if over the last 20 years we've averaged maybe 2% or less, well, a couple years at 5% are still going to keep us below the long-term average of 3 or 4, right? And also, let's face the fact that the Federal Reserve has tried hard to manufacture inflation, and they've barely been able to eke out that 2%. How? By printing of money. All the money that the Federal Reserve has printed really since 2008, since the financial crisis. Because again, if the definition of inflation is too much money chasing too few goods, if we can print more money, so goes the theory, then people will spend it. There'll be an increase of demand. And because it takes a while for the supply of goods and services to catch up, boom, prices will go up. That's the theory. But it hasn't worked. Now, why hasn't it really worked? Because we have a demographic change that has not been accounted for in any of the traditional economics books. See, all the economics books say that if you print more money, it creates inflation because that money will be spent on goods and services. But none of those books question the following. What happens if all that money that goes into circulation doesn't get spent, but instead gets saved and invested? What does that do? Well, what that does is it causes asset inflation, where the costs of traditional goods and services aren't going up, but the cost of real estate is going up. The cost of the stocks in the stock market are going up. And that's what we've seen since 2008 on a pretty steady basis. Now, why is it? Why haven't people been out spending money on goods and services? Because the Federal Reserve has essentially flooded our country with money over the last 13 years. Well, the answer is because we have an aging population. We have demographics. The baby boomers, still a huge part of the population. I'm on the younger end of the baby boomers, barely there. And they go 19 years beyond me. And as baby boomers gradually start to retire, they're spending less. They're going from a big house to a smaller house. They're starting to focus more on their budgeting, right? Especially now, arguably, if they gave up their jobs because of COVID-19 or they can't find jobs that are suitable to them. Now they have less money, they need to spend less, right? So we've had this, what's called a deflationary headwind, with people spending less and essentially the tendency of costs of goods and services to go down because the demand was going down by at least those folks, the baby boomers, not going up, right? And that's the major reason why that the Federal Reserve has basically stood on its head and tried to spit nickels to get inflation by printing all this money over the last 13 years, and they haven't really been able to manufacture inflation anywhere beyond, or in many cases, even close to 2%. Okay? So what changed now? Well, again, it's these two factors of increased demand and decreased supply. The demand is the easiest to answer, right? If you think back to the roaring 20s, right? What caused people to go out and spend money and to have fun and to party and everything else in the 20s? Well, part of it was, the Spanish flu, the fact that they were really held back for 2 to 3 years trying to avoid the flu. They didn't have vaccines back then. They didn't have cures. The death rate of Spanish flu on a percentage basis was much higher than COVID-19. And as a result, people felt like they lost 2 to 3 years of their lives. And when things were finally over, when they had herd immunity, people went out, wanted to party and wanted to have fun. And that's why the economy grew so much in the 20s. But even back then, that's even why the stock market went up so much in the roaring 20s, creating that bubble that burst famously in October of 1929 when the Depression started. So in that case, these people were spending money on everything. They were spending money on investments speculatively. They were spending money on goods and services, right? Well, that's what happened. Really, if you think about it, after the markets dropped in the spring of 2020, is that people went out when we opened up the country again, and especially when we got a vaccine last November, they said, let's go out and let's spend money. So the demand for goods and services went up, and all of a sudden that caused inflation. But that's temporary because we still have this demographic headwind. We still have this older part of the population, myself included, at some point is going to be retiring, if they're not already. That's going to be starting to spend less. That has to tighten their belt. So that long-term deflationary headwind has not gone away. Well, what's happened with the supply, right? Remember, part of it is demand went up. The other part is supply of goods and services went down. Well, anybody who's going to look for a car in the last year knows that the supply of new automobiles is certainly down. And if you want to sell a used automobile, you get trade-in values that are absolutely outrageous because the supply is down. And you hear about these chips, right? The chips that go into the cars. Well, they can't buy enough chips. Well, of course they can't. The supply of those is down. Why? Well, if you read the news, you find out that there's all kinds of container ships sitting offside of LA that can't get to shore. Why? Because they can't hire enough people to unload the ships. And because they can't hire enough to unload the ships, these ships are forced to be anchored for weeks, even for months, with their goods sitting there in containers on the ship and unable to get into circulation. So the supply of goods and services has been slow to resurface, in part because of that, and also because we've had trouble for a while where you can argue that supply of certain goods and materials has been really teetering on the edge even at the end of 2019. And we're going to have a problem at some point where companies have to retool, factories have to retool to create more of these goods. And frankly, that hasn't happened. And then all of a sudden, with the increased demand and the shutdown of an economy, we now know that when you intentionally shut down an economy, a year and a half later, it still isn't back. The supply of these things still hasn't come back. It's taken longer than anybody ever thought. So again, demand will settle back down. We see it settling back down now. People aren't buying primary homes anymore like they were 6 months ago. The bidding wars for real estate has all but pretty much come to an end. But we're still having the issues on the supply side. How long will it last? Well, it's impossible to know. I would have to think certainly by the end of 2022, by the end of next year, we have the supply chain issues fixed, the supply of goods and services back up, and the Federal Reserve is back to standing on their head, spitting nickels, and trying to create even a 2% inflation rate. So I'm definitely in the camp of it being short term. We know by definition it's transitory because inflation is never permanent, right? But the question is how long, and that's anybody's guess. But again, my best bet is by the end of 2022, we'll be back to what we've seen as a recent normal, right? So I wouldn't go out there and change my asset allocation. I wouldn't change anything major I'm doing with my investments because of this. Stay the course, stick to the course. If you're young, you could be more aggressive. If you're older, you got to be more conservative and focus on income-generating investments instead of growth-oriented investments. So don't make any major changes because I think this is just a lot of hoopla in the media that's going to cure itself in the next year or so. I hope that helps. And again, I'm David Scranton from the Income Generation, and thanks for clicking on this video. I hope it helped.